Hi guys, and welcome to the stream. This is my first stream, so yeah, go easy. Progress is everything. In today's stream, we're talking about inflation, interest rates, making and saving money, and how this is going to be relevant for absolutely everybody, including teenagers, if you're in your 20s, your 30s, your 40s, your 50s, if you're not working, if you're working, whatever country you are in the world, it's going to make a big difference. And the more you know, the better you'll be. The more you learn, the more you'll earn. The more you know about, the more you'll save. And if you know it now, in 12 months or 18 months, you'll be thanking yourself for learning this. So make sure to stay tuned and keep watching. It's only going to help you. Got a few minutes, so wait to see if anyone joins. I'm not kind of crossing my fingers because it's the first stream. I only give people maybe 10 minutes notice or something. There's going to be quite a bit in this stream anyway. So make sure to, if you are going to join, even if you're watching it on demand, maybe have a drink, bring some food with you, because it's going to be quite, well, it depends on your level of knowledge, but it's going to be quite intense. It's going to be very useful content. One sec, where did I put my glass? Here we go. But yeah.
Two of me here.
Whoops. There we go. I actually prefer. Which angle do I prefer? Probably the iMac angle.
As you can tell, whoopsies. It's my first stream. So there are going to be some on two. Check. I think this is from the sound element. There we go. Okay, I've actually bought some interesting new devices so that I can make these things a little bit more entertaining. All right, so it's 1:15 now, so we'll kick on. And I'm going to be using a presentation to help me with this, just because it structures things a little bit better. It's not what you wanted to see. So here's the presentation, LiveStream, inflation, interest rates, making and saving money in uncertain times. These are the things we're going to cover. What is inflation? The kind of consensus view on what inflation is. What causes inflation and what is causing this round of inflation. Types of inflation. Inflation's impact on savings, cash and wages. Inflation's impact on debt. Interest rates and inflation. What can we do and how can we benefit? And stick around for some bonus tips. Remember, the more that you learn, the more you're going to earn or save. And the more skills you develop, including knowledge of things like this, the more equipped you're going to be for the future. So first, what is inflation? According to several definitions, inflation is a decrease in the purchasing power of your money, reflected in a general increase in the price of everything, of goods and services in an entire economy. When the general price levels rise, each unit of currency, the value of it, buys fewer goods and services. Inflation corresponds to a reduction in your overall purchasing power. What does that actually mean? Well, if you can imagine your grandparents and ask them how much £10 would have bought them 60 years ago, or the equivalent of £10, you'll realize that £10 would have bought you a lot more. Even me, I'm in my mid to late 30s, and a can of Coke when I was younger, I think might have been 30p, and now it's probably £1 in some places, 75p maybe, or £1. I'm not quite sure, but it's gone up a lot, and that is mostly due to inflation. It's not because Coke's got any better. It's just because inflation, and we'll talk about what causes inflation in a moment. You can also think about house prices. You know, how much have house prices increased? Some seconds. Let's get the file back. So what causes inflation? You don't want my face on too. What causes inflation? I don't know if you can see this actually. So inflation, this is actually a little bit complicated, so I'm going to make it a bit simpler. I had some notes, and you can think of inflation happening from a number of different sources. You have the cost of goods going up. So that's, for example, when actually let's start a little bit further back and say what have been general causes of inflation in the past. Well, in the 70s there was a energy crisis, so I believe that was due to oil prices and the oil embargo. So what can happen when energy sources or products and services high up in the supply chain, so the things people need to buy and use, you know, oil, gas, steel, copper, wood, timber, etc., if those prices go up, then everything below them, you know, all the businesses that are buying those supplies have to pay more. Their profit margins decrease, and that means they have to actually increase their prices to remain in business. So you can see how that can cause an effect. You know, oil prices go up, and then everyone else has to charge a bit more. Remember that oil actually produces a whole ton of things. Plastics come from oil. Oil is obviously involved in petrol and petroleum for cars and in transportation, and transportation is involved with the transportation of food, goods, services, Amazon deliveries, absolutely everything. So that's it from a raw material cost basis. What about other things? Well, if there is a demand and supply chasm, or if there is a demand and supply kind of breakage, for example, if there's a lot of one service or good that's needed in the economy and it's not there, i.e. there's a lot of demands and it can't be filled, then prices can go up. An example of this is after Brexit and after COVID, a lot of older workers left the workforce. Maybe they retired or maybe they decided to change career, and lorry drivers in particular were in short supply. That meant that employers were increased the wages of those lorry drivers, and goods and services went up as a consequence. So that's another style of inflation. That's wage inflation. Typically, that happens later on, and I'll talk about wage inflation a bit later in the video. The other way inflation can happen is when governments print a lot of money. So people saw, or the world saw, rampant inflation or hyperinflation just before the war, the Second World War in Germany, when they needed to print more money. I think it may have been, I don't know my history 100%, it may have been to do with war money and needing to pay back some of their debts from World War One. But anyway, they started to print lots of money, and that decreased the value of their own currency. And interestingly speaking, in 2021, there have been many years of printing money in the UK, the US, and around the world. And I think it's labeled quantitative easing, or QE. But for now, you can think of it as just printing money. And what this does, it's another impact on inflation, and it can drive down the value of your currency, which has a dramatic impact and can cause inflation as well. Now, what do I think has caused this round of inflation? Well, we can put it in here actually. I'm going to do it as I speak. Personally, I think it's down to a lot of different things. I think QE is an important factor. So remember, quantitative easing, that printing of money, I think, is having a big impact. And you can argue that COVID-19 and the recovery effort of printing more money has caused a lot of inflation. In the UK, we can talk about Brexit. I think that has probably caused some inflation with goods and services, lorry drivers, a shortage of certain supplies, goods. If people can't get the components for the things they need, or the workers for the jobs that they need to fill, then that's likely to increase costs as well. This is actually looking a bit. This is looking a bit small, so let's make this a bit bigger. There we go. So we've got QE, we've got Brexit, we've got the shortage of labour. We can talk about lorry drivers, retail workers. There's also, within that, in the US and other places, they're calling it, what did they call it? The Great Resignation. There's a lot of people resigning from their jobs. They realize they can work from home now, something obviously I've been doing for years. But now everyone's realizing they might prefer to do that. So yeah, shortage of labor due to Brexit and other things, as well as this Great Resignation. So you've got a lot of different factors here. You've got some supply and demand. There are certain things that were in very high demands during this period, this pandemic period. Garden furniture. People were doing. I think there was a shortage of certain goods and services due to people working from home and not being able to generate the volume of goods and services. For example, I think timber was affected. I think copper was affected. Steel was affected. I don't know if this was down to COVID. I think it was. But anyway, there was a massive leap in the prices of these things. The demand went through the roof because people, were at home. They had the stimulus money. I probably should put that under here as well. Sorry, QE, but also stimulus money. Stimulus checks in the US. In the UK, we call it furlough money, and business loans as well. So people like had a lot of money. Everyone, more or less. I was actually one of the only people that didn't benefit from this scheme because I was freelance and for various reasons. But most people, if you're an employee, you had furlough. If you're a business, you had business support grants and loans, etc. Anyway, so we've got quite a lot of factors here. Supply and demand. Let's go back to that. So things like raw materials and shortage of certain items. And you can argue to a certain extent, private marketplaces like eBay and Amazon may have impacted prices. If you think about things like the masks people were wearing, then COVID masks, right? Cool. Okay, we've got a lot to get through. So I think we've done that basically. So we've still got a lot to do, but just to summarize, what's causing this round of inflation in particular? 2020, 2025, let's say. I don't know. We'll see. I don't know how long it's going to last, but what's causing this? Well, I think, QE, stimulus money, you can argue that's under that. Brexit in the UK and maybe Europe, shortage of labour, great resignation, supply and demand of certain items, not being there. So I think they're the main factors. There may be some others. If you think I've missed any, then feel free to put it down in the comments below. What we're going to do now is we're going to have a few minutes break. If you haven't already, make sure you subscribe to the channel. Progress is Everything is the name. I'm going to quickly have some water and go to loo, but I'll see you guys shortly. And we're back in. Yeah. Okay. So what we're going on to now, types of inflation. We've talked a little bit about this. We've talked about wage inflation, which I think is kind of normally the last thing, unless there's a supply and demand issue. So that's when wages go up as a consequence of high demand. Supply chain, if there's a shortage of a certain product in the supply chain, then a price within that supply chain can go up. For example, if there's a certain engine part for a car that's in short supply, then the price can go up in a simple supply and demand. But if that happens consistently across certain industries, more than once, more than a kind of one-off thing, it can cause a chain reaction throughout the whole economy that everybody starts to charge more for component parts, and yeah, it causes a chain reaction, so it can cause inflation. And we've talked a little bit about raw materials and how energy and things that are very high up the food chain or supply chain can cause real problems. There was an oil embargo where the oil drilling nations, OPEC, in the mid 1970s, I believe, decided to restrict oil or raise the price of oil. But the impact, we don't necessarily all need to be experts on this, but the impact is when raw materials are either when the supply of those raw materials are constrained, prices go up, or if producers decide to increase prices, then that can have a massive impact on inflation. Another time that in the UK we had massive inflation was the early 90s, where I think it went to 8 or 9%. That was due to us leaving the exchange rate mechanism, which was something to do with the EU. I don't know so much about it, but I know it was to do with currencies, and it caused a massive upset and a devaluation of the pound. A couple of currency speculators, George Soros, I believe, made some money from this, which isn't advised for the average person, because I don't believe the average person can make money, that much money, from currency speculation. 1 second. Sorry. I suppose this happens when you're live. You have to blow my nose. Apologies. There we go. So yeah, so I mean, we did leave the EU. The UK has left the EU with Brexit. So I wonder if I actually felt that we might have inflation back in 2017 and 2018, but we haven't had that yet. But it's starting to. I think in 2020, and we're now in the end of 2021, approaching 2022. I believe it's roaring now. Inflation is definitely going up. So trade issues, just general trade issues can cause all these problems: supply chain issues, raw material issues, wage inflation. Because if you have a trade disagreement, a country could restrict certain goods or services, like oil, like gas, like maybe a specific type of worker or specific service. In the future, it might be data or AI or robotics or whatever. But trade issues can lead to inflation. Okay, so what are the other? I think it's important to also. There's a lot of terms that are bandied around, on the news, which are kind of a little bit confusing. And sometimes people talk about, the government talks about good inflation, the Chancellor for the Exchequer talks about good inflation. What does that mean? Well, a little bit of inflation is a good thing, they say. And oh, I think my stream is gone. One moment. 1 second. I'll try again. Oh, that's not it. One moment, guys. Sorry for these technical problems. I guess it's the first stream, so. There we go. So we're talking about good inflation, some terms that are talked about in the news. So what is good inflation? This is the target rate of inflation that the UK government, a lot of governments around the world kind of want. And why do they want around 2% inflation? I think a little bit of inflation is good because, it's kind of a healthy thing for the economy. Economists, without going too much into the excuse me. Sorry about that. Without wanting to go too much into the detail, economists don't want low inflation or deflation because what that does is people don't basically they wait to buy things and that constrains people spending and then businesses go bust and lots of bad things happen. So they want a little bit of inflation in the economy and they target around 2% as being good inflation. Before this recent period of rising inflation, a lot of economists were saying that the inflation they were seeing was transitory inflation. What does that mean? Well, transitory inflation, according to those economists, is inflation which is just temporary. It's only going to last a few months. It will be gone and it won't cause any more inflation around the economy. Now, from my understanding, and I'm not a PhD economist or anything like that, but inflation is a chain reaction, so it's unlikely that it would ever be transitory because one thing leads to another. It's kind of consequential. When there's a limited supply of some goods, when there's a higher demand for some workers and they're leaving the economy, all these different factors. And when there's Brexit, when there's loads of money being pumped in, there's all these different factors. I never believed that it was transitory at all. So that leads us to another another way we can describe inflation, and that's persistent inflation. Now, it's a little bit misleading, that kind of phrase, persistent inflation, because like everything in the economy, lots of things are cyclical, so they work in cycles. So even economies that have a lot of inflation, for example, Turkey or Argentina, it's in cycles. So they won't have inflation, for 50 years, but it might come on for 10 years, off for 10 years, that kind of thing. And there are some countries in the world that have fairly high levels of persistent inflation. I think Brazil and Argentina have been, pretty high for some time. But in general, when we're talking about, right now around the world, I think what I would class as persistent inflation is when it's going up and when it's hard to bring down. For example, the certain levers that the central banks can pull aren't working. We'll have to see what happens there. And if inflation gets out of control, it's sometimes known as hyperinflation or rampant inflation. We have seen this in certain countries like Venezuela, to a certain extent in Turkey, Zimbabwe. All of these are fairly recent examples. The more historic example would be Germany, where there's famous pictures online where people would wheelbarrow buckets of cash just to buy a loaf of bread. So that's they're the kind of main phrases that are bandied around in the news. So if you've yeah, that'll really help you in terms of if you're following this elsewhere in the news. Right, guys, we're going to take a bit of a break now. So I'm going to take a 2-minute break. If you haven't already, consider subscribing. Progress is Everything is the name of the channel, despite my name here saying iMac. I don't know if I can edit that. I might be able to. I certainly can. So I'll change. Whoopsies. Change this. But yeah, if you haven't already, make sure you do subscribe. I'm not going to be talking too much about the macro environment like inflation, interest rates per se, but when it does impact personal investment, personal finance, the everyday lives of everyone, then I'm going to talk about it because I think it's really important. And I think that inflation and interest rates are going to impact absolutely everybody. And I think that it's really, really important to understand them in some level of detail. You don't need to be, an economist or anything. So anyway, I'm going to take a 2-minute break. I'll be back and we're going to talk about the next thing. Stay tuned. Okay. Hi guys, and we're back. Oh, I briefly had somebody on the stream, but they came in the break, which is a shame because then they're no longer here. Anyway, this will be available on demand, of course. So what we're talking about now is inflation's impacts on savings, cash, and wages. Apologies for the grammatical error with the lack of apostrophe. But anyway, yeah, we're talking about the impact on savings. What impact does inflation have on savings? Well, inflation has a negative impact on all non-rising assets. So if you have cash or savings in the bank, even if they're earning a percentage that you think is good, it has to be higher than the rate of inflation, or your cash is basically going down. So your savings will be decreasing. An example of this is if inflation is 5%, which it is at the moment. I believe it to be higher than 5%. I can't put an exact figure on it, but I can see prices going up 10% in a lot of different areas. I wouldn't be surprised if it's 10%. But anyway, they're saying at the moment it's 5.1%, I believe, in the UK. If your savings are earning anything less than 5%, then you are losing money. So it's bad in terms of the effect it has on savings. They lose value, which is a shame. What about cash? If you actually hold physical cash, sometimes people think that the safest place you can put cash is under the sofa or under the bed or hiding it. But unfortunately, the impact on cash is exactly the same as before. You know, with the impact on savings, it will decrease rapidly if inflation persists at 5-10% a year. Let's say in 3 years it's running at 10%. That's your cash is degraded at a compound rate of 10% a year. So if you had £100, it would go down to 90. The second year, it would go down another £9 to 81, and then roughly, and then another £9 roughly in the next year. So it'd be worth something like £72 after 3 years. Your £100 has reduced to 73. Meanwhile, everything else in the market has gone up. For example, things that you buy and rent and bills will have gone up roughly the rate of inflation. So actually your cash hasn't just depreciated by 20-30%. Instead, it's probably gone down about 50% because everything else will have gone up. Now, I'm not saying that inflation is going to be 10% a year. I don't know what it's going to be, but even if it's just 4 or 5%, the impact if you hold cash is twofold. First, that it's going down, and second, everything else is going up. So you get a double whammy of negative impact. So you don't really. I personally, I'm not a financial advisor, so I can't give advice, but I don't think it's a sensible idea. I wouldn't do it, and I'm not doing it. So there you go. It slowly becomes worthless for the reasons I've just mentioned. What about the impacts on wages? Now, it's quite interesting actually with wages because there's a couple of things. Firstly, in the start of an inflationary period, wages don't typically rise, but everything else goes up. But employers are kind of reluctant to raise wages because it costs them a lot, and it's a cost that it's not very flexible. That cost once you increase wages, it's very, very hard to decrease wages. They're not. I think in business it might be called an elastic cost. It's kind of it's a fairly fixed cost, and you can't aside from firing people, which people do not like to do for various reasons. The reaction to inflation from businesses is not always to increase wages. When do wages get increased? Well, when there's a increase in demand for certain types of labor or skills in the marketplace. For example, we saw recently lorry drivers are needed to help with the transportation of goods and products and things from different ports. Their wages, I think now they're at the time of filming, the most recent thing that I heard was that they doubled. Now that's really a supply and demand thing. It's not really inflation. But I've been hearing from recruiters and from the news that there is now an impact on wages across the board. Certainly in retail, that's had an impact from the pandemic. But overall, everybody wants to earn a bit more because things are going up. So it does happen. Wages do go up. They slowly. Oh, whoopsie daisies. Let's get all of this. So they slowly rise in most cases, as I mentioned, except where demand outstrips supply, lorry drivers. But even so, it's unlikely that they'll rise faster than the price of goods because businesses need to make money before they spend money. That's kind of the way it works. I was going to have another break here, but I think I'm going to ramp on ahead. I will say that knowledge is power, especially the right kind of knowledge, and progress is everything. Make sure to subscribe to the channel. Let's move on. Inflation's, let's get it right this time, impact on debt. So we've already talked about in a previous section that inflation's impact on cash, it kind of destroys the value of cash. What about debt? What does it do to debt? Well, depends on the type of debt. If you have small debt, it doesn't impact it that much. You know, if you had a debt of $500, £500, €500, you know, 5% inflation or 10% inflation is not going to have that much impact. It's really not. But it will have an impact. You know, it will have some impact, especially if it's persistent inflation, especially if it lasts, you know, 3, 4, 5, 6 years. Then the cost of your debt will go down, and we'll talk about that in a moment when I talk about the larger debt. So I think that's where it gets very interesting. How does it impact large debt? Basically, it's very interesting. The price of the debt or the value of the debt goes down, and that might seem strange, but it can have a huge impact on larger debts such as mortgages and government debt. Right now, this is a bit harder to understand, so I'm going to try and take some time to explain it in as concise and easy to understand way as I can. So, let's remove that text editor. I'll give you an example. The price of things are always going up. There's always a little bit of inflation in most markets. That's certainly what we've seen, you know, over the last 50 to 100 years in the UK, right? And in most markets around the world, barring places like Japan, which have seen something slightly different. But anyway, most things go up in price, and when they do with inflation, especially when inflation is high, the price of debt goes down because the value of your currency is going up. So you're earning, for example, if you bought a house in 1960 and in a nice suburb of London. I know this because I can give you my grandfather's example actually. He bought a house in Blackheath, which is a very nice area of South London. I think where a lot of well-to-do people live, you know, ambassadors and MPs and, you know, famous people at the time were living in Blackheath. I don't know I'm not quite sure about now, but anyway, he bought that property. Not sure when he bought it, but a long time ago, and he bought it for £1,000. And when he sold it for £40,000. And recently, I looked at some houses on the street because my father told me the name of the street. I can't remember it for this broadcast. But those houses now sell for £2 million, right? So the thing about this is it's not just when we're talking about house price, it's not just price appreciation because the quality of housing is going up. That's not right. Inflation is a massive part of why house prices go up, and I think they show a really interesting example, because if you had a interest only mortgage on a house, let's say you bought it in 1960 and it cost you 10k, $10,000, pounds, euros, whatever, and then you had a 35-year mortgage in 1995, let's say in London, you know, a 10k house in London in 1960, and you sold it in 95, might have been worth 150k. And if you had an interest only mortgage, then at the end of that mortgage term, they would say, okay, Jake, you need to pay your £10,000 mortgage off now. And you would easily say, you know, well, the value of the property is 150. So you could either sell the property, pay off the debt and buy another property, or, you know, you'd have lots of options. And the reason is because inflation decreases the cost of debt, but earnings go up. Now, average earnings in 1960 were probably quite low. But by the 90s, you could earn 30,000 a year. You know, I think my father was earning maybe 30,000 a year in the 90s. And, you know, if you'd have bought that property for 10K in the 60s, you can see that whilst the debt stays kind of the same and kind of goes down because of inflation, like wages over time do go up, and over the course of one's career, you know, you do better and you earn more money. The impact on larger debts, such as mortgages, can be very large. What about personal loans? It's the same with personal loans. Over a period of time, if you get a personal loan, let's say for 10,000, I'm not encouraging anyone here. You know, this is just my opinion, and I'm talking about it from a mathematical perspective, not from an advice perspective. So, just using the example of a £10,000 loan now, if you get that 10K loan, and there's inflation of 10% a year for, let's say, 5% a year for the next 20 years, like the actual cost of that debt will be close to zero in 20 years time. Now, it's very rare. You're not going to get a personal loan for 20 years, but you might get a mortgage for 30 years. And there's an interesting intersection. What's that again? There's an interesting intersection between when you can get debt, when it's cheapest to get debt, and when it's expensive to get debt. Now, at the moment, at the time of speaking, interest rates in the UK are 0.25%. I was very fortunate. I maybe saw things coming a little bit, and I fixed all my mortgages when the interest rate was 0.1%. I didn't get 0.1% because banks always charge more than the base rate. So I think I got between kind of 1.8 and 2.5%. But already the interest rates went up a few days ago, and I've saved a lot of money on the interest payments. I think it's going to work out between 15,000 and 30,000. I haven't done the raw calculations, but that's what it's looking like already. If interest rates go up further, then my savings will be larger. So it can have a big impact. And governments have a lot of debt. Whoopsies. Governments have a lot of debt. And the bigger the amount, the more beneficial it is to have a higher inflation rate, because the cost of that debt goes down. So they want highish inflation. That's not really a word, but they want high inflation to a certain extent, but not too high, as they don't want to raise interest rates too quickly. That's quite important. If the governments, it's not the governments actually, it's the central banks. So in the UK, it's the Bank of England. In Europe, it's the ECB, or the European Central Bank, and in the United States, it's the Fed, or the Federal Reserve. These are the institutions that have the power to increase interest rates, and they don't want to increase it too quickly. But the Fed has said last week, this is December 2021, that they're going to raise rates 8 times in the next 2 to 3 years. And typically, from a financial perspective, the UK does things quite similarly to the US. For example, the Federal Reserve raised the interest rates on Wednesday or Thursday last week from 0.1 to 0.25 in the United States. And then a few hours later, the exact same thing happened in the United Kingdom. Okay, guys. Well, I hope you enjoyed that video on inflation's impact on debt. It might be hard to understand, but to summarize, inflation has a pretty small impact on smaller debts, but still does decrease the value of it. On larger debts, it can decrease the value of things like mortgages. And from a personal perspective, the other thing is, if you have buy-to-let mortgages, then rents are likely to increase when inflation is around. So you have this interesting double whammy, that if you fix interest rates at a low rates, like what I've done, and you can increase rents, your debt goes down, your income goes up, and you fixed all of your risk, if you like. So that's really interesting. Similarly, if you fix your mortgage and your wages go up, then you're going to be in that position as well. So I can't advise what anyone should do, but I've certainly spent some time thinking about this and making sure that I fixed some of my variable costs, some of these interest rate costs, with loans and mortgages. And I'm going to celebrate with my partner and my business partner when I can. At the moment, there are some risks at the time of speaking in terms of going out, because we're in the second round of a global pandemic. But nevertheless, I think that you should celebrate when you make good decisions. Guys, knowledge is power, especially the right kind of knowledge. And progress is everything. I'll see you guys after the break. Okay, let's get back into it. Welcome back. Still no one watching, but it is my first live stream, and it is the middle of the day. Some people will be working. I imagine a lot of people will be also with friends and family, which is cool. So we're talking about interest rates and inflation. How can interest rates impact inflation, and what normally happens? Well, governments don't really have, or central banks don't have a lot they can do when inflation goes up. But one of the triggers they can pull is interest rates. And typically, governments and central banks don't like to raise interest rates too fast because it can really impact the economy. It hurts. Who does it hurt? It hurts businesses because they will have lending. And if they want to get loans, or even if they have a part of their costs that's variable, then their loans may increase, their rent may increase, their costs will increase. Individuals, obviously, it hurts probably mortgages the most, because that's typically the largest cost that people have. And if you're sitting on a variable rate, or you're tracking the market with a tracker mortgage, then you're incredibly at risk when interest rates rise, especially if the mortgage is new, meaning that you bought recently. An example of this is in London. If you do a very, very quick example of why interest rates shouldn't rise too quickly. if you bought a 1-bedroom apartment in London, you know, a typical cost might be something like £400,000. If your interest rate was 2%, then your cost would be pretty low. You know, really not affordable, let's say. We can actually do the calculation now. Actually, let's just do it now to be exact. I'm going to quickly look at just let's say 1-bedroom flat in London, right? Wow, there's some for so much money. Let's all right. Well, let's just look at this this one here. I'm going to share my screen so you can see it. I think this is really interesting. If you haven't looked at this kind of thing before, then it will go a bit trippy. There we go. This is a nice apartment complex. It's new. I mean, the images look fantastic. I don't know if you can see this, but it just looks. If you're a first-time buyer, you might think this is perfect. It's got beautiful everything. Absolutely lovely. Linden Homes, so it's a reputable developer. Yeah, it looks. Look at that! Doesn't that look lovely? But it's 465. I've got this tool which tells you the price change history. So it's actually come down from 485. It seems kind of crazy. It's not that big. It's 1-bedroom, and well, let's have a look how much that would cost in mortgage payments. So say you got a 10% deposit. So it would be about 1,800 right now, right? But let's say interest rates go to 5%, which means if you want a variable rate mortgage or a tracker mortgage, it's likely to be 2% or thereabouts above base rate. So say 7.5. Suddenly you're paying over £3,000 a month. Now that doesn't include. This is a leasehold flat, right? So leasehold normally have charges. This looks like there's no ground rent, but it's the leasehold charge that you want to be wary of, because they also charge something for that. So there you go. I'm going to stop sharing that. But that's something to be very, very mindful of when you're buying a property. And if you do have a property like that, a 1-bed or a 2-bed that you bought recently, and you feel that the mortgage payment's pretty high already, I would recommend, and I can't give my advice, but if I were in that circumstance, I would be phoning my mortgage broker and discussing my options in case interest rates rise further. Now remember that the US economy has said, the US government and the US officials within the Federal Reserve, which is the institution that coordinates and constructs the interest rates for the United States, has said that it's likely to have at least 8 interest rate rises in the next couple of years. The UK often mirrors the United States. So I would, if you do have one of those properties, definitely discuss it with a professional. Would be something I would do. Let's go back to the deck, because that's what we were talking about. So interest rates can be used to bring down inflation. Rates do generally rise when inflation is going up. This is to try to control inflation. This is what they're doing at the moment. So lots of individuals may suffer regarding their mortgages and any personal debts. If they're looking, for example, to get a loan to help pay for mortgages or for work or whatever, loan prices are likely to increase. So if you're going to get a loan, it's not advice, but if I were looking to get a loan, which I am, I'm going to do it pretty soon because interest rates are going to go up and loan payments are going to go up as well. But you can fix, if you do it quickly, you can fix and you might get an affordable rate. Businesses may go bust because their costs go up as well. The government's own lending costs go up. They've taken on an enormous amount of debt. In the US, even Elon Musk is saying that the cost the governments have racked up is unsustainable. I think it's trillions of dollars that they owe. In the UK, it's no different really. It's monumental. So what else happens? Banks' profits suffer because people and businesses start to default on certain debts. Plus, I know this because I've worked at a bank in the lending department. Worked for NatWest and for Barclays Bank. And the other thing they do is they tighten up their lending criteria, which means they're less likely to lend money to people that actually need it. And they only tend to lend money to people in a very good credit situation, people that have a good credit score. So you really, if you're in a position where you have a big mortgage, maybe if your job's at risk, anything like that, you want to be thinking about this kind of thing early, because you don't want it to, come round too quickly, because a lot of the doors start shutting. If you like, the doors of opportunity to help people in this situation, they start closing pretty quickly. From what I understand, having worked at a bank, banks only really want to lend to people that are going to pay them back, and they have very strict criteria. Their profits suffer because they can't lend out as much money to as many people, and even the people they think that are good start to default if interest rates go up too much too quickly. Now they might not, so this is kind of what can happen. It's not what will happen; it's what can happen. Innovation may also suffer because businesses are less likely to invest in R&D, research and development, new innovations, new products, new services, because they're looking to hamper down and conserve cash. Not all businesses will do this, but some businesses, especially the ones that don't have big profit margins, which is a lot of businesses, and they slash their R&D budgets. So that's kind of what can happen with when interest rates, when inflation goes up, and when interest rates are used as a mechanism to try to control inflation. Guys, we're going to take a break soon, but be back for the next part. We'll take a short break, but remember that knowledge is power, especially the right kind of knowledge, and progress is everything. I'll see you shortly. Okay, so been a little bit over an hour, but I have taken breaks, so that's good. Just move some of these lights. There we go. So we're going to move on to the next thing, which is what we can do about all of this. Let's just, my bad. There we go. What can we do all about it if interest rates are rising in 2020, late 2021, 2022 and beyond? How can we benefit? Well, I've already mentioned that saving and cash isn't necessarily the best way to go. Oh, that's great grammar there. Cash is dies. So, yeah, basically, if you don't use your cash, you lose it to a certain extent in a high inflationary environment. So, you know, that's really one of the things about my channel. It helps, will help you in terms of learning about the different opportunities for cash. You know, I invest in property, stocks, startups. I'm potentially interested possibly in a little bit of cryptos, but I'm investing in assets which build cash flow, which is something that you want in this environment. Debt becomes cheap when the cost of debt is low and interest rates haven't risen a lot, which is right now. You know, interest rates are 0.25, which is still very low. At the moment, don't think banks have raised interest rates on their products too much yet. So debt's pretty cheap, probably one of the cheapest it's been. Certainly the last 2 years is the cheapest I think ever been. Can't imagine it's going to get much cheaper ever, but it might. I've been wrong before. And so debt's pretty cheap. And, you know, I'm going to be doing other videos about good debt, bad debt, because it's not as simple as I think the media and other people like to think. You know, most people, I may get comments saying that debt is the worst thing in the world. I'm never going to believe that. There are lots of billionaires with debt. So I don't believe that all debt is terrible, especially when debt is very cheap and when you can get big cash flows from it. In finance, they call it return on capital employed, ROCE. That includes return on debt as well as return on equity. Don't want to get too technical, but basically, when debt's used well, and it's used to generate returns, it's not a bad thing. It's only when you're buying sofas and going on holiday with and cars and things which lose money. So if you have debt, maybe consider your options. Just what I did, I fixed 3 mortgages last week, which I think will save me between 20 and 30,000 pounds. Remember, I fixed them between 1.8% and about 2.5% for 5 years. In fact, I need to phone to fix a 4th mortgage. I want to see if I can fix that until 2027. But yeah, the amount you can save on interest payments per month is considerable if you fix a low interest rate. So that's something you can do. And off the back of that, I've had conversations with my fiance and my business partner, and we're going to invest in assets that are inflation proof. I'm going to be making more videos about all this kind of stuff because I know there's probably going to be questions about this. If you have any questions, feel free to put them down in the comment section below. I'm also on Quora. If you search for Jake W, then you'll find me on Quora. And there's going to be a Discord community that I'm going to be setting up very soon. If you haven't already, then definitely consider subscribing. I think that's we don't need to put in this 2-minute break, but if you haven't already, woo! As you can tell, PowerPoint isn't one of my skills particularly. But anyway, yeah, if you haven't already, consider subscribing. It really helps me. I put some time and energy into these live streams and into the videos that I do. I'm fortunate that I have had, I'm having a few days off from Facebook. I received this in the post actually from Facebook, which is lovely to get something. They've given me a personalized book. It says Jake's Hopes and Dreams from Workplace, which it's now called Meta. It's not called Facebook, but there you go. I might look at that a bit later on. Anyway, I hope that you found the information in this. If you're watching on the live stream, interesting. If you're watching on the separate videos on demand, I hope that you've watched all the videos in the playlists. I hope that you'll find what I find, that knowledge is power. The more you learn, the more you can earn. And yeah, I think it's important, if you haven't watched my other videos, watch them all the way through, because I'm making these videos from the lessons that I've learned over time, and it will save you a lot of heartache, and you won't need to make any of the mistakes I made. And you know, if I knew what I knew now when I was 20, there's no doubt I'll be worth millions and have a slightly different life. So if you are in your 20s and you can learn what I know now, then there's a good chance that you will do incredibly well. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. I'll see you guys in future videos.